Forget the dry consultant reports. Forget the polished decks from McKinsey and Deloitte. Let us talk like people who are actually breathing the air of the American financial market right now. Because something has changed. And if you work in finance in the United States, you can feel it. Not in theory, not in some futuristic keynote, but in the office, in the branch, in the spreadsheet, in the inbox, in the jobs that used to feel safe. The question in 2026 is no longer whether AI will replace people. The real question is much colder. Who has AI already replaced? And who is next? Today, we are talking about 10 finance jobs that are not just under pressure. They are actively disappearing. Some people will call this fear-mongering. But the market does not care about our feelings. The market rewards speed, leverage, accuracy, and cost reduction. If your job is built around repetition, data entry, basic analysis, or summarizing information that already exists, you are standing in the danger zone. Let us start with junior tax accountants. For decades, tax season meant long nights, stacks of receipts, messy spreadsheets, and exhausted people trying to survive filing deadlines. Now a customer can connect bank accounts, upload forms, answer a few guided questions, and let AI-driven tax platforms prepare the return in minutes. That does not mean tax expertise is dead, but basic tax preparation is being crushed. And emotionally, that hurts. Imagine spending 4 years in college, studying accounting standards, grinding toward the CPA path, only to watch a $20 monthly tool do the mechanical part of your job faster than you ever could. The move is simple. Do not compete with software on data entry. Become a tax strategist. Clients will not pay premium fees because you can add numbers. They will pay because you understand structure, timing, entity choice, deductions, risk, and legal tax planning that protects real money. Next comes the entry-level equity research associate. This one is brutal. Wall Street used to need armies of young analysts to read annual reports, build models, pull historical data, and summarize management commentary. Now AI systems can scan hundreds of pages in seconds, compare filings across years, extract key metrics, flag language changes, and produce a first draft before the analyst finishes coffee. The Ivy League badge still opens doors, but the badge alone is not enough anymore, especially if your main skill is formatting Excel tabs at midnight. AI can read the numbers. AI can summarize the filings. AI can compare margins and guidance. Your edge has to move higher. You need to understand alternative data, consumer behavior, supply chains, management incentives, market psychology. And what the CEO is not saying on the earnings call, the analyst who survives is not the one who copies numbers fastest. It is the one who forms judgment when the numbers are incomplete. Third, bank tellers. Walk into many American bank branches today, and the change is obvious. The branch is becoming a service kiosk. ATMs are smarter. Apps are better. Identity verification is faster. And many routine transactions no longer require a person behind the counter. The painful truth is that friendly small talk cannot justify a high fixed cost when a machine can handle deposits, withdrawals, transfers, card issues, and account questions around the clock. That does not mean human banking disappears. It means human banking moves upmarket. If you work in a branch, the path forward is relationship banking, small business banking, private client service, and wealth management. People still want humans involved when the money is large, when the decision is emotional, and when trust matters more than convenience. Fourth, loan officers. Traditional lending once depended heavily on human review, credit scores, income documents, debt ratios, employment history, and a person deciding whether the borrower looked reliable. Now, underwriting models can evaluate far more signals with far more speed. They can process bank activity, cash flow behavior, transaction patterns, fraud indicators, and risk markers that no individual officer could manually review at scale. The emotional part is harsh. Human judgment can feel warm, but algorithmic judgment is fast, consistent, and frighteningly efficient. You cannot beat AI at instant pre-approval. So stop trying. The opportunity is in complex credit, business loans, real estate development, special situations, restructuring, and cases where numbers alone do not tell the full story. AI can score a borrower, but humans still matter when a deal requires context, negotiation, collateral judgment, and a serious read on character. Fifth, traditional insurance agents selling basic products. Many Americans now buy insurance the way they order food. Open the app, compare prices, click through options, bind coverage, done. For basic renter's insurance, auto insurance, pet insurance, and simple homeowners policies, the middleman is being compressed. Companies built around digital underwriting showed customers that insurance does not always need a long conversation. And once customers trust the interface, they stop waiting for the agent. The emotional hit is real. A salesperson who once explained everything personally now watches customers' trust ratings, recommendations, and automated quote engines instead. The answer is specialization, cyber insurance, AI liability, executive risk, commercial coverage, catastrophe exposure, and complex policies that require interpretation. Basic coverage is becoming automated. Complex risk still needs expertise. Sixth, reconciliation clerks. This job is in direct conflict with automation. If your daily work is matching records between systems, checking whether numbers agree, finding breaks, and moving items from one bucket to another, you are doing exactly the kind of task machines were built to absorb. Automated ledgers, APIs, blockchain-based records, and AI reconciliation tools are making manual matching look obsolete. This is not a small efficiency gain. It is a structural change. Do not become the door latch when the world has moved to fingerprint locks. Learn the systems, understand controls, manage exceptions, audit the automation, and become the person who knows why the break happened, not just the person who found it. Seventh, floor traders. The classic image is loud, chaotic, human, people shouting orders across a trading floor, tickets flying, phones ringing, adrenaline everywhere. But that world is mostly a museum piece now. Most trading in major American markets is electronic. Algorithmic strategies and high-frequency systems dominate execution speed. No human can compete with machines that react in microseconds. The lesson is not that trading is dead. The lesson is that manual execution is dead. The surviving skill is strategy design, risk management, market structure knowledge, model oversight, and the ability to understand when an algorithm is behaving dangerously. If you cannot beat the machine, build it, supervise it, or control the risk it creates. Eighth, junior KYC and AML analysts. Know your customer and anti-money laundering work used to require huge teams reviewing documents, screening names, checking sanctions lists, monitoring transactions, and escalating suspicious activity. Now AI can scan massive volumes of transactions, detect patterns, compare identities, flag anomalies, and connect dots across datasets faster than any manual team. The low-level review function is shrinking, but financial crime itself is not shrinking. In fact, it is becoming more sophisticated. That creates a better path. Move from box checking to investigation. AI can surface the signal, but humans still need to build the case. Understand intent, interview stakeholders, work with regulators, and explain what happened in plain English. The future is not basic compliance review. The future is financial crime intelligence. Ninth, retail financial advisors serving the mass market. This one makes a lot of people uncomfortable. For years, many advisors built businesses around portfolio allocation, risk questionnaires, mutual fund selection, and periodic rebalancing. Now, robo-advisors can do that at low cost, automatically, at scale, with simple dashboards and almost no friction. For a customer with a modest account, a diversified automated portfolio may feel good enough. That is the dangerous phrase, good enough. If your only value is building a basic portfolio, your fee is under attack. The answer is not to sell more charts. The answer is to sell peace of mind. Tax-aware planning, retirement decisions, estate conversations, behavioral coaching, family goals, debt strategy, career transitions, and the emotional side of money. A robo-advisor can rebalance an account, but it cannot sit with a nervous client during a market crash and stop them from destroying their future. 10th, financial copywriters and technical report writers. AI is already very good at producing market summaries, daily updates, earnings recaps, economic briefs, and clean technical explanations. It is fast. It does not get tired, it does not misspell words, and it can update instantly as new data arrives. That means generic financial writing is being commoditized. If your work sounds like every other market note, AI can probably imitate it and maybe improve it. The defense is originality, personal experience, specific judgment, deep interviews, real stories, clear opinions, and insights that come from actually living through risk. AI can describe a drawdown, but it has never felt the stomach drop of losing real money. That is where human writing still has power. So here is the reality check. The American financial market has no patience for stagnation. It does not protect a job because that job used to matter. It does not preserve a task because people trained for years to do it. If the task is repeatable, measurable, text-based, rules-based, or heavily dependent on moving data from one place to another, AI is coming for the workflow. Maybe not your title today, but definitely the work inside that title. And once the work changes, the headcount changes after that. The smart response is not panic, it is repositioning. Do not fight AI as if it is a rival employee. Make it your junior analyst. Make it your assistant. Make it your first draft engine. Make it your research accelerator. Make it your error checker. Spend 1 hour a day learning how to use AI inside the job you already have. Automate the repetitive parts before your employer automates you. Then move toward judgment, strategy, client trust, complexity, investigation, negotiation, and leadership. The people being replaced are not simply finance professionals. They are finance professionals who refuse to evolve. So the question is simple. Are you going to stand there and watch the shift happen? Or are you going to take the wheel? Because in this market, your next click may decide which side of the transition you are on.